Good morning, everyone. Today, we're going to explore why trading through a limited company can offer a slight advantage over being self-employed using real-life illustrations. We'll also discuss the crucial IR35 legislation and why, as a company director and shareholder, you need to be registered for self-assessment. Let's break this down in practical terms. Let's start with the fundamentals. As a self-employed individual, also known as a sole trader, you and your business are legally the same entity. That means all profits are yours, but so are all liabilities. If your business runs into trouble, your personal assets, like your home or car, could be at risk. In contrast, a limited company is a separate legal entity. This separation means your personal assets are generally protected from business debts. If the company faces financial difficulties, your liability is limited to what you've invested in the company. Now let's talk about tax. As a sole trader, you pay income tax on all profits and national insurance contributions, or NICs. For the 2025 to 2026 tax year, this means paying up to 45% income tax in Class 2 and 4 NICs in your profits. A limited company, however, pays corporation tax on its profits, currently at a lower rate than the top bands of income tax. As a director or shareholder, you can pay yourself a modest salary, taxed via pay. Then take the rest of your income as dividends. Dividends are taxed at lower rates, and for the first £500 are tax-free in 2025 to 2026. Suppose your business earns £50,000 in profit. As a sole trader, you pay income tax and NICs on the full amount, potentially losing over £15,000 to tax and NICs. With a limited company, the company pays corporation tax, let's say £9,500, leaving £40,500. You pay yourself a small salary and the rest as dividends. Your total tax bill could be a few £1,000s less, depending on your circumstances. But remember, since April 2016, dividend tax rates have increased and the tax savings are less dramatic than they used to be. The real advantage is now slight, but for some, it's still meaningful. Limited liability means your personal assets are protected. A professional image, many clients and investors prefer to work with limited companies, which can help you win contracts and attract investment. It's easier to raise funds since you can sell shares in your company to raise capital, which isn't possible as a sole trader, and more deductible expenses. Limited companies can often claim a wider range of business expenses, reducing taxable profits. Let's meet Jane, a freelance IT consultant. As a sole trader, Jane's profits are taxed as income, and she pays national insurance contributions on the full amount. Jane switches to a limited company. She pays herself a £12,000 salary, which is below the national insurance threshold, and takes the rest as dividends. After corporation tax and dividend tax, she finds her take-home pay is around £2,000 higher per year, enough to cover her company's annual accountancy fees, with a little left over. Here's the catch: IR35 legislation. IR35 is designed to stop people from avoiding tax by working as disguised employees through their own limited company, when in reality, they're working like regular employees for a client. If you're caught by IR35 or inside IR35, you pay income tax and national insurance contributions as if you were an employee, wiping out the main tax advantages of a limited company. Your client may deduct tax at source, and your take-home pay drops, often to the same level as if you were employed directly. How do you avoid being trapped by IR35? Well, work for multiple clients, not just one. Control how, when, and where you work. Avoid contracts that require you to work under direct supervision, or provide exclusivity. Make sure you can send a substitute to do your work and document this in your contracts. For example, if Jane works for one client at their office under their direction and can't send a substitute, she's likely inside IR35. Her company's tax advantage disappears, but she still has to pay for the company's admin and accountancy costs. If you're a company director or shareholder, you must register for self-assessment if you receive untaxed income, like dividends, expenses, or director's loans, in addition to your salary. Now, if your only income is a salary tax through pay, you may not need to register. But if you receive more than £10,000 in dividends, you must register and file a self-assessment tax return. Other untaxed income, such as director's loans, benefits, or other sources, also require registration. So, how do you register? Register online with HM Revenue and Customs by 5 October, after the end of the tax year in which you received untaxed income. You'll need your national insurance number and personal details. Once registered, you'll receive a unique taxpayer reference, or UTR, and must file your return by 31 January each year. To sum up, trading through a limited company can offer a slight tax and liability advantage over self-employment, but only if you're genuinely operating as a business and not as a disguised employee. IR35 is a real risk. Get your contracts checked and take professional advice. And remember, as a director or shareholder, you're responsible for registering and filing self-assessment tax returns for any untaxed income. Thank you for your attention, and always consult a qualified accountant or tax advisor for advice tailored to your situation. For tailored guidance and professional support on your business journey, connect with Ayo Oyebade at Crown King Accounting Services. You can reach out via email at ayowa@crownking.accounting.co.uk. Your financial future is in safe hands.